Hello Deep Valley community, thank you for joining me. Today I'm going to talk about zero-sum investing. The topics in this video include path to wealth and investing versus speculating. If you're new to the channel, please subscribe now. This is our value investing journey and I hope you find these videos useful. Let's move on. First I want to clarify the difference between speculating and investing. When you're speculating, you are essentially trying to guess what another market participant is going to do. You're trying to predict whether the stock is going up or down. When you're investing, you're trying to make a gain alongside your business, the business that you have a part ownership in. You're trying to participate in its wealth over time. Moving on. What does zero sum mean? Every time you buy a stock, on the other side of that equation, there is someone selling you the business. The seller believes there's no more money to be made in that investment. You as a buyer are trying to sell later on at a profit. On net, over time, you guys will cancel each other out. Now, when people have had a few gains, speculating over a short period of time, they boast about it, they talk a lot about it. But when they start making losses, the mind, we human beings have this ability to very quickly put away pain. You can read about this in behavioral psychology. We overcome pain by forgetting it. So you don't hear speculators talk about their losses. You only hear about their gains. But if you look at their portfolio, their returns are not impressive. A little trick that I employ is I only talk about investment losses. I let the gains speak for themselves over time. What this does, it makes me forces to the front of my mind why I made a loss in XYZ. And so that I keep going back to it, and I keep remembering why I made a loss. What was wrong with the business model? What was wrong with the thesis? So remember Buffett's rule number 1, do not lose capital. And I employ that. If you can go over time, over a period of 2-3 years, without having the portfolio have a loss in that year, you were able to compound strong returns over time. It truly is the 8th wonder of the world. Moving on. What I think can work out much better over time, and what billionaires tend to do, is they're invested in a business. Even so-called market activists like Carl Icahn or Bill Ackman, if you look how long they're invested in certain businesses, there's several years, sometimes up to like 6-7 years. So you're much better off being invested and participating in the wealth of that business over time. Now, everything that I've spoken about today is a question of practice versus theory. So we've spoken about theory, and this all makes sense right now. But when you're in the market, everybody is an investor while the share price goes up. But when the share price comes down, you start doubting yourself. And now that's when the real investment begins. Because you're holding that loss, what do? So my belief is that you put the work in before you buy the business. Now you're never going to know everything about the business until the day you buy the first share in the business. When you bought the first share in the business, you are now an owner of that business. You care about that business. You go to sleep, you think about that business. So the work has to be done before, while realizing that you're not going to know all the solutions, all the problems to everything about that business until you own that business. But the most important work is the preparation to being the owner of the business. So I hope you found that video useful. And as always, please subscribe.